You probably didn't notice it, but a critical warning light in the financial system started flashing recently, and it's all related to the repo market. The repo market is acting up and sending us these warnings that we haven't really seen since before the COVID crash of 2019. The SOFR, the Secured Overnight Financing Rate that holds the entire financial system together, has suddenly started spiking, and it broke free of the Fed's tether, meaning that Jerome Powell doesn't have control over interest rates that he desperately needs, and he risks losing control of monetary policy altogether. And funnily enough, this all relates back to these repeated crises we're seeing in the shadow banking sector, in the private credit market, and within regional banks all over America. And in this video, I'm going to show you why the repo market is sounding an alarm, what it says about this hidden leverage tearing down the economy, and once again, why this relates so perfectly to what Jamie Dimon recently said about cockroaches emerging from the woodwork. And of course, this video is sponsored by Surfshark, so keep an eye out for them, more on later. So really quickly, let's just recap what the repo market actually is and why does the SOFR rate matter. Well, the repo market is basically where banks and big investors stick in storage high quality collateral like US Treasuries in exchange for cash. And they do this on a nightly basis, pretty much every single night. It's basically just a place for the financial system to exchange liquidity amongst itself on a daily basis to keep the system functioning. Say that one bank needs an extra $500 million to stay within its collateralization obligations, well, it borrows that much from the repo market, and another bank with more cash than it needs to stay collateralized can earn a little bit of interest on that loan. The interest rate on these overnight loans is the Secured Overnight Financing Rate, and it usually sits a few basis points below the Fed's main rate because the loans are backed by solid collateral, usually US Treasuries. In other words, lending cash against Treasury bonds is supposed to be super safe, so the interest rate stays nice and low. Now, the federal funds rate, by contrast, is the rate on unsecured overnight loans between banks. Normally, the SOFR should be slightly cheaper than the federal funds effective rate, since adding Treasuries into the mix equals basically a little bit of less risk. So when the SOFR jumps unexpectedly, it's a sign that even secured lending, backed up by the single highest quality form of debt in the world, is feeling the heat and that there are problems at play. Now recently, the SOFR started doing something it's not supposed to do. It's jumping to its highest levels, above even the Fed's own target range for rates, meaning that banks are paying more for overnight cash than the Federal Reserve wanted them to pay. Now you can see exactly what I mean by this chart right here. The straight lines are the federal funds rate, the upper and lower limit, and the orange line is the Secured Overnight Financing Rate. And for the most part, it stays neatly within the range, except for right before the Fed cut their rates back in September, and more recently over the last couple of weeks in October as well. That orange line creeping outside that upper limit of the federal funds rate shows the Fed losing control of the financial system and risk in the entire economy increasing. It started on September the 15th, where the SOFR spiked to 4.5% from 4.4% the day before, the biggest one-day jump since New Year's Eve. Now that may not sound like much, but in the conservative world of overnight lending secured by US Treasuries, this is huge. And that spike wasn't because the Fed hiked rates or anything like that, because they didn't. It happened independent of policy, hinting at stress within the financial system. So why did the SOFR break out? Well, analysts point to a classic squeeze of worsening liquidity. The US Treasury has been flooding the market with new bonds to finance their deficits, and the Fed is simultaneously draining cash out of the system by shrinking its balance sheet through quantitative tightening. So liquidity is being squeezed in both directions. A surge in Treasury bill issuance this summer sucked a lot of that cash out of the banks and hedge funds and the like, leaving less money available for overnight loans. And on top of that, we just hit quarterly corporate tax deadlines in mid-September, where big businesses withdrew piles and piles of cash to pay off their taxes, which again is basically like taking money out of the financial system altogether. So with those fewer dollars around in the system, the banks and funds suddenly weren't so eager to lend them out overnight, so they demanded higher rates due to the risk premium, and we saw the SOFR briefly at first break free of control of the Fed, but that briefness has now been repeated last week and this week as well. And just by looking at this graph, you can see how actually the SOFR used to sit fairly consistently right in the middle of the Fed's target range, but it's been creeping ever higher. Now this isn't just happening because there's a bit of a liquidity crisis that we've already been mentioning on this channel for months now. There's another more nervous factor, which is of course counterparty risk. Now, normally in a well-functioning repo market, lenders aren't too worried that they're going to lose money. After all, if a borrower can't repay that short overnight loan, well, the lender just keeps the treasuries as collateral. And as treasuries are pretty much as good as cash most of the time, and, forgive the pun, the gold standard, a default really isn't that much of a big deal for the most part. But when stress in this system rises, banks start to get a little bit skittish about who they're lending to, even with collateral. And if you suspect that the firm on the other side of the trade might get in trouble, or might suddenly be in trouble by the time morning comes around, you either don't lend to them at all, or you charge them a premium for the risk. And right now, we're seeing hints at that kind of caution creeping in. The recent rise in the SOFR suggests that some banks would really rather pay extra to borrow cash from safer sources, or even just hoard their own cash and not partake in the repo market at all, than rely on the usual lending channels. It's the same trust no one reflex that we see in almost every credit scare. And again, I know a lot of people will still struggle to understand why there's a risk premium when the loans are supposedly risk-free. If the other party goes bankrupt overnight and say Bank A loses $500 million in cash, well, they've still got $500 million in treasuries instead, so what's the problem? Well, treasuries have that maturity date, and having to sell treasuries to realize cash before that maturity date is not an ideal situation, especially when yields have been rising in recent years, and there are literally trillions of dollars on treasuries currently held on the books of banks, which would lead to serious losses if they weren't sold today. This is the exact same thing that took down Silicon Valley Bank back in 2023. They had too much money or cash invested into treasuries, they had huge unrealized losses, and they had to sell the treasuries to realize that cash, and in the process realize those losses, which took them down. Now, if you've seen my channel before, you know that I live here in the UK, and I'm not exactly a fan of our government. I've spoken out a number of times against the Online Safety Act, which is an authoritarian piece of legislation being used by the government right now to try and suppress the flow of information online. Now, that's a serious issue for Brits, but there's similar legislation in the EU doing the same thing, and let's be honest, it's not like the US has a great record when it comes to spying on their citizens or censoring information online either. So if you want to protect yourself online and make sure you can always access the internet or information without government censorship, take a look at this video's sponsor, Surfshark VPN, who fixed this problem. Surfshark VPN has thousands of different server locations all around the world that you can connect to virtually, so your internet thinks you're in that location. I'm constantly using Surfshark to find free access to journalism for making these videos because the UK's Online Safety Act requires me to give over all of my personal details to the government so that they can track me, just so I can read some tweets on X. Surfshark is super fast and secure, and if you're not completely satisfied, they have a 30-day full money-back guarantee, so there's no risk to you. And you can use code STOICFINANCE to get 4 extra months for free. So go to surfshark.com/STOICFINANCE or click the link down below in the description if you want to protect yourself from government overreach and even get those 4 extra months for free using code STOIC. Now back to the liquidity issue, and there are concrete signs confirming that the buffer of excess cash in the system right now is evaporating and it's almost entirely gone. The Fed's overnight reverse repo facility, where money market funds stash that excess cash for safekeeping when they have too much on their books overnight, that has seen usage plunge from a peak of $2.6 trillion at the end of 2022 to basically nothing today. All that spare cash that was parked on the sidelines has been sucked back into the market, or rather into financing the government's bond issuance and debt creation programs, and that means there's just not much liquidity in the markets left over right now. At the same time, banks have started quietly tapping the Fed's standing repo facility, a kind of emergency tap that the Fed opens up when the financial system is struggling because, again, there just isn't that much liquidity in the system and it's starting to break. Now, in mid-September, usage of the SRF jumped to levels that we haven't seen since the COVID lockdowns wreaked havoc on the entire world, as banks have basically been forced to say, hey, Federal Reserve, we urgently need some more cash right now, please. Now, some people are out there arguing this is just a temporary blip, a known quarter-end tightness that will pass as it has occasionally in the past. But actually, this is really worrying. The reserve elasticity, which is just this fancy economics term for how easily the system can lend out extra cash when banks need it, has clearly deteriorated. And the Dallas Fed even noted that funding conditions are trending toward constraint, which is a very polite way of of saying that the buffer is actually much thinner than it looks, and it's getting steadily worse as we progress into this crisis. In plain English, things that used to not be problems, like a week of big treasury auctions, they're now causing rates to wiggle uncomfortably to break free of control of the Fed, and it's causing banks to have to resort to the literal final place where cash can be printed out of thin air and added to their books, or else they themselves will be breaking the law for being under collateral limits. The problem with the repo market, with liquidity in the markets and even the Fed's control over the financial system, as those problems are all real. But let's rewind to the last time that the repo market truly broke and what happened as a result. Now, it was mid-September 2019, and without warning, overnight, repo rates spiked from around 2% to as high as 8 or 10% in a single day. And no, that's not me making a mistake either. The rates literally quintupled, blowing past the Fed's target and far and away outside of their control. Banks that needed cash overnight were suddenly paying 10% interest on it, like it was coming from some dodgy pawn shop using the fact that the banks were desperate to profit off of them. The immediate cause of this was that same 1-2 punch that we're seeing right now as well. A large batch of corporate tax payments plus a big settlement of new treasury bond purchases, which drained about $100 billion out of the financial system overnight. The big banks, which normally would lend into the repo market to smooth things out, they pulled back instead because they were constrained by post-2008 liquidity rules and they worried about their own reserve levels. So they decided to just hoard cash instead of lending it out for a very small amount of interest. And the result was a classic liquidity squeeze. Everyone who needed cash at the time, the banks who had invested too much and didn't keep an eye on their reserves, they were just out of luck and they had to pay insane interest rates to remain collateralized because no one was willing to lend it otherwise, and the financial system literally broke overnight. That 2019 spike was a rude awakening for the Fed, and they were caught completely off guard. The Federal Reserve had to intervene immediately with massive overnight lending operations. The New York Fed began pumping in tens of billions of dollars every single day. At one point, they actually printed as much as $100 billion in daily repo loans to flood the market with enough cash to bring those rates back down and to fix the liquidity crisis. Now, eventually, the Fed's interventions did calm the repo rate and it went back down to normal levels. But it was clear that the system's so-called ample reserves weren't ample after all. Those ample reserves can basically be irrelevant when big banks all decide to sit on their cash at once, and that 2019 crisis forced the Fed to set up a permanent fix, or what they hoped would be a permanent fix. They stopped shrinking their balance sheet for a while, and they later introduced something called the SRF, or the Standing Repo Facilities, so banks could always turn to the Fed for overnight cash if needed. The idea was to have a safety net in place so we'd never see a repeat of that spike again, and the banks, if they ever need to, can basically order the Fed to print money at will. Now we fast forward 6 years to 2025 and some uncomfortable parallels are emerging. Just like in 2019, we have first of all falling bank reserves. Back then it was due to Fed tightening and regulations. Now it's partly because of massive bond issuance and continuing quantitative tightening from the Fed. Then number two, we have big cash drains. Tax day was coming in for businesses, and so there were heavy treasury settlements, and that's again the culprit, the same as in 2019. But with number three, it gets a little bit different. This time, banks are reluctant to lend, whether due to the regulatory limits or more likely the fear of counterparty risks, or just even the fear that holding US treasuries isn't as safe as it might have initially seemed, and that we see now lenders are pulling back and letting rates rise. In both cases, a minor liquidity shortfall led to outsized moves in rates, underscoring how non-linear these kind of things can get when that cushion thins out and things start to become problematic. Now, there are also critical differences here, and thankfully, this is why the system hasn't totally blown up yet like it did in 2019. Banks today do hold more in reserves than they did in 2019, and the Fed's secured repo facility backstop is open for business and doing its job. In 2019, the system was running literally on fumes. Liquidity had almost completely run out, and there was no Fed backstop to pick up the slack. Whereas in 2025, we still have about $3 trillion in reserves at the banks versus the about $1.5 trillion that was in reserves in 2019 when that crisis happened. So we've got a slightly higher baseline. And on top of that, the Fed's new repo facility acts like a pressure release valve, letting off steam when needed. And looking at what is happening right now, as soon as those pressures are appearing, banks are borrowing from the secured repo facility to the tune of right now about $11 billion a day. That's probably one reason we didn't see an extreme 10% rate explosion like we did in 2019. The Fed has essentially put a ceiling in place. Banks know that they can borrow from the Fed at around the Fed's policy rate, so no one should pay way above that unless things are truly melting down. And when the SOFR expanded above the federal funds rate, as we've started to see over recent days, instead of just paying those higher interest rates to borrow from other banks, the banks that desperately need that cash are borrowing from the Fed instead. Now that might sound like good news, and it is in a way, but it's also very clearly a problem. The difference between 2019 and today is that right now the Fed is printing billions of dollars every single night and injecting it into the banking system to keep it from collapsing. Back in 2019, they didn't have the process or the system in place to do that. The fundamental problems are still there. The risks within the financial system are still there. The liquidity crunch in the system, it's still there. It's just the Fed has pre-made a bailout for these banks, and they're using the bailout before the problem explodes and reaches those mainstream headlines. But of course, this doesn't all stop here, and whilst the banks themselves are technically fine, there's a solution waiting ready for them whenever they should die from poor risk management and a liquidity crisis. The rest of the economy, we don't have access to that same backstop that they've got. So we are all going to suffer as the fundamentals behind this problem continue to grow. A spike in repo rates has big implications for the broader financial market. We can basically think of the repo rate as the foundation of the entire loan or credit market. It's the rate at which a liquid asset like a treasury can be temporarily turned into cash pretty much on an instant basis. And so when there's problems within the repo market, even if they're relatively short or short-lived, it sends tremors through stocks and bonds and asset prices and mortgages and even credit cards and everything else within the financial system. When repo funding gets expensive or scarce, banks and investors have to pull back from other risks and basically turn off the credit for everyone else. We already saw a hint of this. The day those US regional banks dropped their bad loan bombshells last month, right, Zion and Western Alliance Bancorps, when we saw that happen, at the exact same time repo rates jumped. The S&P 500 index dipped and safe havens like gold spiked to record highs. And even across the pond in Europe, bank stocks fell too because there was so much fear of contagion. About 37 billion euros was wiped off of European bank market value in one day because of a little $50 million hiccup on a random regional bank in America that none of us had ever heard of before. And the risk that posed to the repo markets and the entire financial system was severe. So what are the actual consequences of this, and how is it going to hit you and me and everyone else? Well, this all at the end of the day impacts the ability of banks to access cheap capital. So when their access to cheap capital disappears, or rather when the capital just gets more expensive, funding costs go up and credit costs go up as well. The repo market is often called the first domino because all the other debt in the entirety of the US and really the world follow the repo markets. If overnight borrowing costs rise, it doesn't stop there. That leads to longer term borrowing costs in other areas as well, and not just for banks either. Say for instance, if banks are paying more to get overnight liquidity, they're going to be forced to charge more for longer term loans, for corporate credit lines and mortgages that you and I might take out. And a sustained rate in the SOFR effectively tightens financial conditions across the board. It's like a sort of invisible rate hike that the Fed didn't actually want in the first place, but they can't really control anymore. Now, companies might find it more expensive to roll over their short-term debt, which would put pressures on their businesses. Investors in things like corporate bonds or junk debt are going to demand higher yields if they sense that the basic funding environment is getting stressed. And everyone in the economy starts pricing in more risk, and the interest rates paid onto every form of debt start to rise. Even if the Fed themselves are slashing rates trying to make the financial market stronger, it really ends up with a mind of its own and we can't fully control it. The Fed can just a little bit influence it right up until it breaks its tether and everything falls apart. Now, the ultimate problem here is that the Federal Reserve sets the baseline for overnight rates through its federal funds target rate and by paying interest on bank reserves. It has tools like the standing repo facility to cap those extreme problems and moves, but this whole recent problem underscores that the Fed doesn't have perfect control over the market. They can supply liquidity, but they can't force banks to lend to each other with confidence in each other. The Fed can fix a liquidity shortage, but it can't fix a trust shortage. And if banks are nervous, say about each other's exposure to bad loans or too many treasuries or whatever else it might be, well, they're going to pull back anyway, and the repo rate will move despite Fed policy. That is exactly what we're seeing happening right now, and this might force the Fed to stop their quantitative tightening, to stop its balance sheet runoff and start printing money all over again. If the repo market keeps acting up like this, I would actually go so far as to say that it's almost a certainty that quantitative tightening is stopped and it's replaced with quantitative easing once again, and then we start risking the high inflation environments that we've seen in recent years all over again. And it's also worth noting, this isn't just a US issue either. Global markets pay attention to US liquidity because the dollar system is the backbone of the global financial system. So in October, European and Asian markets struggled a little bit as well when those US banks revealed their bad loan problems and those repo rates jumped. Even the IMF, the International Monetary Fund, has flagged this in October in its meetings. They warned that strains in the non-bank financial sector, which is code for shadow banking or private credit, could morph into a broader crisis if not addressed. And this is where the entire story comes together. It's where the private credit sector or the shadow banking sector is revealed as the core cause behind the lack of trust in the financial system and the reason that every single financial institution is terrified of counterparty risk right now. So this all starts exactly where you're thinking it started, with First Brands Group, with Tricolor Holdings, with Zion Bancorp and Western Alliance Bancorp. And I don't want to bore you, we've been over this to death at this point, so I'm not going to go super in depth on each specific bankruptcy because you can just watch some of my last few videos on this channel if that's what you want to look at. But to summarize, since the 2008 global financial crisis, banks have had to be more careful with their money. They're watched more closely by the authorities, they're not allowed to take as many risks as they used to, and the banks didn't like this one bit. Before they crashed the global economy with their mortgage-backed securities scam, the banks made hundreds of billions in profit for years on end, and they obviously didn't want that to stop. So even if those new regulations told them they had to stop, they were going to find a way around it, and they did. They simply outsourced the risk and they hid it into smaller companies and subsidiaries that aren't banks but basically behave like banks. Tricolor Holdings is one of those companies. They sold cars with loans, and not just any cars or any loans, but bad cars with bad loans to people who couldn't afford them. Then they packaged those loans up into groups and sold them on as securities backed up by the assets in case the loans went bad. Just like we saw in 2006 with mortgage-backed securities and the housing crisis. The problem is that now, for Tricolor Holdings, loads of those cars are gone, shipped out to Mexico or wherever else, and even more of the cars never actually existed in the first place. The debtors have defaulted on their loans and they can't pay them off, and the securities that echoed the housing crisis of 2006 are now worthless, just as we'd expect them all to be. But before Tricolor collapsed and lost their investors all this money, they hid the fraud for years on end and made loads and loads of profit. And who else made loads in profit from this scam at the same time? The banks. They just didn't get involved themselves. Tricolor was the risky one doing the risky stuff that the banks couldn't touch. So instead, the banks lent money to private credit institutions or subsidiaries of themselves, who then lent money out to Tricolor, and suddenly, banks like JP Morgan, their hands were clean. The exact same sort of thing happened with First Brands Group as well, and Zion Bancorp and Western Alliance Bancorp as well. They used private credit or the shadow banking industry to clean their hands whilst they funded incredibly risky, yet for a while, profitable schemes. And then when the schemes backfired and everything fell apart, they lost lots of money and they had no choice but to announce it to the world, and the crisis commenced. And as these little scandals keep popping up, with a shadow bank here and a private credit institution falling there, and all of them basically tracing their funding back towards banks, legitimate banks, the counterparty risk in the financial system is rising off the charts. There's likely hundreds of billions of dollars lost in the private credit markets that just hasn't been exposed or revealed yet, and every time a little bit more is exposed, the counterparty risk will grow and the impact to the rest of the financial markets and the repo markets will grow too. The recent problem with the repo market is like a valve blowing off steam from the deep plumbing of finance. It's telling us that all is not well beneath the surface. We've got a tightening liquidity, we have private credit falling apart, and even global financial titans like Jamie Dimon losing sleep over the risks that we're seeing here. This doesn't mean that there's a financial apocalypse that's assured to happen next week based on the shadow banking sector, but the conditions for broader trouble are in place and the situation is steadily deteriorating. The repo market is usually invisible to most people, but it's where these cracks are starting to show early, so if you've never paid attention to it before, now might be a really good time to start paying attention, to make sure to follow this channel, because I will be paying a very close eye to it and ensuring that when these cracks grow or new ones appear, you know exactly when and why it's happening, because when the lights flicker in the repo market, it is really, really dangerous for all of us everywhere else as well. And again, thanks to Surfshark for sponsoring this video. Make sure to go to surfshark.com/stoicfinance or click the link down below in the description if you want to protect yourself from government overreach and get those 4 extra months for free using code STOIC.